All right, guys. Today's going to be about more of macro perspectives on stocks or on any asset, and why day trading is very difficult. And yes, I am developing an edge right now in day trading that I haven't. I talked about it actually in videos from a few months ago. I'm not going to revisit it too much though, because I'm still trying to work out how to test optimal stop loss and take profits and stuff. So I won't get too into that. But what I'm going to talk about briefly is why day trading is different than long-term position trading or swing trading, right? Because if day trading was as easy as long-term trading, then everyone would just do it, right? But there's a reason why a lot of massively successful traders trade on larger time frames. And it kind of really dawned on me the reason why it's the case just now. Like, for example, the reason why Kulamaji trades breakouts on a daily chart, basically. And the lowest time frame that he really looks at is like an hourly chart. He may enter based on the 5-minute chart of an opening range breakout, but there's no technicals he's doing on a 5-minute chart. He's looking at the overall trend. And the reason why he's doing that is because of something that people may refer to as dilution. People will talk about volume. They'll talk about float rotation. These kinds of things are the reason why day trading is a lot harder to be profitable in. And what am I getting at here? What I'm getting at is that money can't move that fast. Now, you might think that's a stupid thing to say because money should be able to move very quickly in this day and age, and it tends to flow in and out of markets every second. And that's true. But big amounts of money don't move that quickly. And people who are managing large amounts of money and placing decently sized bets with those large amounts of money can't just get in and out of a market like you and me. Like, they really do need to find liquidity, because if they close an entire position, if you close like a 7-8 figure position, or even like a 6-figure position in a market, it's going to move the market, right? Like, you're going to get absorbed by buyers or sellers with part of those orders if you market order, which you probably have to market order, or you're iceberging. They probably are iceberging, actually, honestly. If you don't know what an iceberg order is, you can go look into that. Maybe I'll explain it later. I've never actually used an iceberg order, so I'm probably not the best person to ask about those. But iceberg orders are basically they're kind of like more complex limit orders that are designed for big players, where they exit in portions. They exit parts of their position, and they may exit it at a very varying range of price. Like, they'll exit their position within a range of prices in pieces, in order to prevent from moving the market too much, and also to prevent from being identified as a single entity. It's the way that a big trader preserves their edge, so that people can't other big traders couldn't exploit them and be like, oh, all those orders are from this one trader. Anyway, off topic. I mean, not off topic, but just kind of a side note. But if you have to iceberg in and iceberg out of positions, then you can't really be a day trader that easily, right? And because you're getting filled at a range of prices, and not just at one exact price, which you and I, as aspiring smaller traders, we don't know what that's like to deal with. But if your account size grows big enough, eventually you'll find out why iceberg orders exist, and eventually at a certain account size you will have to use iceberg orders in order to preserve your edge, or prevent it from getting eaten into to a large degree. But anyway, if you're trying to put millions of dollars into a stock or into a market at one time, you need like a decent payout on it. The kind of payout that honestly you're probably not going to see within just one day of price action, right? Unless it runs a ton. So you can't just be throwing $7 million in, taking $7 million out, got back and forth type of thing frequently, like multiple times a day. I mean, you could do it. I just don't think it's optimal for that kind of position sizing. And if you think about Wall Street, like who the big traders are, is they are pretty risk averse people, right? They don't necessarily go for massive gains. They may try to make like 10% a year, if that, right? But that's probably like what a well-respected Wall Street trader who has succeeded for decades is probably aiming for something around like 8% annually returns, right? Which isn't even really. That's like, I don't know the exact performance of the S&P, but that's kind of similar to the S&P, right? But anyway, these people are risk averse. So these big positions, the positions that move the market, are being placed by risk averse traders, which means that they're not just going in and out, in and out, in and out like you and I can do. Okay, like you and I have tried to do. So the price of a stock cannot be expected to move too much on one day. Now, of course, there's black swan events, like people going crazy over Nvidia or whatever. Of course, they happen. But even when somebody catches those kinds of moves, they may take profit quickly on that. But most likely, if they really had conviction, they'll probably be holding that trade for even bigger gains. But basically, they're not trying to make their income within a single day of trading, right? They're not trying to make the income they make, like you go into work at 9:30 a.m. and then you leave work at 4 p.m. and you made your money for that day. Again, I'm sure you guys have heard other people talk about this before, but like this really is true. The 9 to 5 hourly wage mentality is the reason why you and I have gone into the markets with it wanting to be day traders, is because we have all worked those low income jobs where you're getting paid an hourly wage. So your mentality really is, I have to make my money for the day. Now, of course, you're greedy about it and you think, like, I want to make $500 a day. I want to make $1,000 a day. I want to make $50,000 a day. And I want to be able to close my positions and sleep well at night and not worry, and then go back and do the same thing the next day. And the reason why in most cases that doesn't make sense is because if it were possible to do that, then everyone would do it, right? I'm not saying everyone would do it, but like what I mean by everyone is like, if that were possible, then you would have heard of a lot more of Wall Street day traders by now, correct? Think of the most famous traders you've heard of. Are any of them really, and the richest ones, are any of them really day traders? There may be a handful, but I guarantee you don't know them just for their day trades alone. Like a lot of them also do long-term position trades. And that's what I'm getting at here is these people, they're not putting in their money to take it out the same day. Okay, it's in that sense, it isn't a casino, right? It's a casino for the people who are trying to put it in and get the payout the same day, right? And I'm not saying you can't do that. I'm not saying there aren't ways. I even have a bot that does that. But there's more to the market than that. And I personally, I would recommend this, and this is what I personally am doing, is that while I do have an automated day trading strategy, I have several of them and I'm working on more, I also am looking at long-term position trades. So, for example, I just bought some of Palantir. Reason being, to me, this looks like a kind of a cool emoji setup, and I'm buying a bit high here because I didn't notice it today. But if you think about it, it actually closed very close to where it opened. So this is almost like an easy opportunity to get in late on a cool emoji breakout. But if you can see, this is a high tight flag, right? This is exactly what cool emoji talks about. There's a high tight flag. You've got earnings surprises, like earnings beats. it's cyclically bullish, right? It did chop a bit, honestly, it did, but again, like for example here, this is a Coolamaji breakout right there. This kind of consolidation, it was a little choppier, but you could see a larger breakout wedge, or whatever he calls it, a high tight flag forming kind of here too. And it's not perfect, but like it's very Dan Zanger-ish, okay? And then some news just came out today that made it even more bullish, but you can see that this stock has it has buying pressure on it. Now, I'm not saying my position here is going to work out. It might get countered, it might fail. If it fails, then somewhere in here is probably a good buying area, though. If it's just being countered and sell stops are just being ran so that like a big trading house can scoop up inventory before it goes up, then this right here is probably a good buying area. This gap right here, and I would put a stop at the low of this candle right there, or at this swing low right here. But somewhere in there is a good entry. But I personally think that it might not go back down to there for a long time or ever. Again, this is not financial advice. This is just one example of what I'm looking at. And it was looking at this, it really dawned on me like, hey, there's only so much money flowing into this at one time. Like, let's look at the volume. And there's only so much money that can flow out of it at one time, right? So you've got a lot of money flows into it here. It trades away from it, trades just about back into that candle, which I've talked about, where high volume candles become rejection areas. And now it's moving away from it again. But they can't just like, you can't just day trade this, because look at this on a lower time frame, okay? Look what happened today. What's going on here? Could you have caught this short? I doubt it. Could you have caught this long? More likely. Why? Because it has a overall long bias. So again, you're applying the long-term macro trend intraday. And so the thing is if you're doing that, then what would be the point of exiting your position here? If you really are correct that this is a long, then you should be holding this overnight, because this thing could run over 100%. This thing could run hundreds of percent in the next year or two. Who knows? That's the way Coolamaji looks at this. And I'm not just trying to parrot him, because now the reason I'm seeing it now is because it's really dawning on me now, like how true that is, right? So of course, in my heart, I'm a futures trader. I'm a futures trader. Fine, we'll talk about the edge I'm developing a bit, right? Look at this. These lines are where different major stock exchanges open around the world. This is over, we've got like the Asia, Australia part of the world. The New York session often counters those levels. You've got like, you move on to Europe and London, then you've got the Fedwire. But look at this. Boom, 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 boom. Runs all of the Asian traders who tried to trade right from the open in their country. The people who are doing like what you and I are doing at 9:30 a.m. here, or wherever you are, the people over in Asia are, this is that for them. And I'm not necessarily saying they're trading the NASDAQ, but they are, okay? But they're most likely trading their own index. But the fact that their index is interrelated with our index, because they all connect to one another. So if one index moves, it has a ripple effect on all the other indexes, but the ripple's instantaneous, right? Like literally, when it is day trading positions, like if the Hang Seng index moves, the NASDAQ is instantly going to move very similarly, like with a very small delay, right? And I'm not saying it's going to move up when one moves up, but if one moves up and it has a reason to make the other go down, they'll go down. But generally speaking, the stock indices around the world they do kind of all tend to move up together. Now, there are exceptions and they're not all perfect, but generally speaking, like stocks are a hedge against inflation, especially like tech stocks. And every big major country in the world has their own tech stocks that have an impact on the outside world, right? So that may sound vague, but trust me, that is kind of how it works, basically. The indexes from every major country is basically comprised of their biggest companies, and some of their biggest companies are going to be their biggest tech stocks, right? Or however close they can get to being like a tech stock, whatever that country is a big exporter of in terms of innovation, like that's going to drive their index. And so when there's a recession, the whole world tends to go in a recession. When there's a bull market, the whole world tends to go in a bull market, right? So it doesn't really matter which index you're trading anyway. You might as well just trade the one that that's your home country. But anyway, the point is that when this comes down like here, we could, maybe I'll have to prove it, but like, look, let's go Hang Seng. Okay. So where's today? Okay. So look, now these are different times. I guess they kind of show up differently, but as you can see, hold on, what the fuck? What the fuck? I'm confused. I swear these lines are at different times now just because I switched to something different. That's weird. That shouldn't be like that. Because wasn't this one at like 8 o'clock p.m.? Why are there no lines there? Okay, anyway, I guess I'll have to work on that. TradingView is weird and can be buggy at times, but that doesn't make any sense. But anyway, what I'm saying is like, okay, so this is the stock market open. This is based on New York time though. There's a sell-off right from the open, correct? Okay, so if we go back to NQ, right at the open, there's a sell-off, right? So that's what I'm talking about, is how they move similarly. They may not move completely similarly, but like a massive move downward like this, you can guarantee that at the same time there was a downward move in just about every major stock index, right? So this isn't necessarily attacking Asian traders, but it's representative of the fact that the Asian countries' stock markets are attacking Asian traders, right? But you do have to assume that some of those Asian traders are trading the U.S. indices because we have the biggest market in the world, right? So it's kind of it's a combination of an interrelation of all the indexes, but also attacking traders that are in this market from that side of the world. If that makes any sense. I can't physically prove this, but like give me another viable explanation of why price would run down exactly to where all these stock market opening times are and then reverse from there. When you also know that big position traders need to use iceberg orders at high liquidity areas in order to get filled. Okay, if you put 2 and 2 together, it's kind of the only viable explanation. Okay, so anyway, thanks for watching, guys. This actually ended up being a little longer than I expected. That kind of tends to happen with me. I ramble a bit, and there's just a lot to say about the market. But I hope this makes sense to you. I kind of just jumped around, but with futures, money can move in and out quickly. Don't get me wrong, but that's also because these big futures are like blue chip stocks, right? And blue chip stocks don't move a whole lot in one day, right? Like they can, but relative to like smaller stocks, like something like Palantir could move 30% in a day. Apple on a good, like its best days is what? 7%, which is crazy for Apple. But so big money can move in and out of this kind of stuff more quickly than it can with less liquid stocks, right? So again, I don't know. I mean, so it kind of, I guess there's a place for everything, but even with the NASDAQ, you have to think, even if this can handle bigger size from a day trading perspective, what does that mean? That means that from a daily time frame, this is going to have absolutely immense size, right? Because think about this, there's always a bigger fish. So if a whale in your and my eyes is day trading a NASDAQ, okay, but who is that whale a guppy to? Because if that whale is a guppy to someone, that bigger whale that they're the guppy to is trading this on the daily time frame. And then that person's going to be a guppy to a weekly time frame whale. And then that person's going to be a guppy to a monthly time frame whale. Does that make sense? That's kind of how this thing is fractal. Is the lower the time frame you go, the less liquidity there is, and the more chaotic it will probably be. The bigger the time frame, the less chaotic it will be because it's more clear and it's easier for a big, massive whale to take on a position and determine a trend. Correct? I hope this helps. Take care, guys.